If you've ever wondered how investors make money in the stock market without constantly buying and selling, then dividend stocks are one of the easiest places to start. They're simple, powerful, and perfect for beginners who want to grow their wealth over time. So welcome back to Stock Predictor, where today, we're breaking down dividend stocks in the clearest and most beginner-friendly way possible. By the end of this video, you'll know exactly what dividend stocks are, why companies pay dividends, how you can earn them, and whether dividend investing might be the right choice for you. Let's start with the most basic question: what exactly are dividend stocks? A dividend stock is simply a company that pays a portion of its profits back to shareholders. Instead of keeping all the money it earns, the company takes a slice of the profit and shares it with the people who own the stock. This payment is called a dividend. Think of it like being rewarded just for holding the stock, even if you never sell it. As long as you own shares of that company when dividends are paid, you receive cash, deposited straight into your brokerage account. Now, not every company pays dividends. Many high-growth companies, like tech startups, choose to reinvest all their profits back into the business instead of paying out cash. But more stable, established companies, often in sectors like utilities, consumer goods, banking, telecom, and energy, tend to pay consistent dividends. These companies aren't chasing explosive growth anymore. Instead, they reward shareholders regularly. For beginners, this steady cash flow is one of the biggest attractions of dividend investing. So how do dividends actually work? Companies usually pay dividends every quarter, that means 4 times a year. Some companies pay monthly, and a few pay annually, but quarterly is the most common. When the company announces a dividend, it sets an amount per share. For example, if the dividend is $1 per share and you own 50 shares, you receive $50. It doesn't matter if the stock price goes up or down that day. The dividend is yours as long as you hold the shares on the key date called the record date. The company sets this date to determine who qualifies to receive the payment. If your name is on the shareholder list that day, you get the dividend. A lot of beginners get confused about the ex-dividend date, but it's actually simple. The ex-dividend date is usually 1 business day before the record date. If you buy the stock on or after the ex-dividend date, you won't receive the upcoming dividend, only the next one. So if you want the dividend payment, make sure you buy before the ex-dividend date. Your brokerage will always show you these dates clearly, so don't worry about memorizing them. Now, why do companies even pay dividends? For one simple reason: to attract investors. Paying dividends sends a message that the company is financially stable, profitable, and confident in its future. A company that consistently pays dividends, year after year, signals strength. Some of the most trusted companies in the world are known for paying and increasing their dividends for decades. These companies are often called dividend aristocrats, or dividend kings, which means they've raised their dividends for 25 to 50 plus years straight. That consistency builds investor trust and can support the company's stock price. So what makes dividend stocks appealing for beginners? The first reason is passive income. You don't have to trade daily, time the market, or stress about buying at exact moments. You simply invest and collect payments. Over time, the dividend income can become significant. Many investors use dividends to pay bills, reinvest automatically, or build long-term wealth. Imagine getting paid while you sleep, just because you own part of a company. The second benefit is stability. Dividend-paying companies often have strong cash flow, reliable earnings, and long business histories. They aren't usually the types of companies that collapse overnight. Their stock prices may not rise as fast as hyper-growth tech companies, but they also tend to fall less during market downturns. That's why dividend stocks are popular among retirees, conservative investors, and anyone who likes predictable returns. The third benefit is something incredibly powerful: compounding. This is where dividend investing becomes a wealth-building machine. When you reinvest your dividends instead of spending them, you buy more shares. Those additional shares also earn dividends. Then those dividends buy even more shares. Over years or decades, this cycle creates exponential growth. Many investors become millionaires slowly, not by timing the market, but by consistently reinvesting dividends. Compounding is like a snowball that starts small but becomes huge over time. And dividend stocks are one of the easiest ways to unleash this snowball effect. Now let's talk about dividend yield. This is the number most beginners look at first, but it's also the most misunderstood. Dividend yield is simply the annual dividend amount divided by the stock price. If a company pays $4 in dividends per year and the stock price is $100, the dividend yield is 4%. That means for every $100 invested, you earn $4 in dividends each year. But here's the catch: higher isn't always better. A yield that looks too good to be true often is. If a company's stock price is crashing because of serious financial problems, the dividend yield may shoot up. Many beginners think this means the stock is a great deal, but in reality, it might be a warning sign that the company can't afford its dividend. Companies can reduce or cancel dividends at any time, and when they do, the stock price usually drops even more. So what is a healthy dividend yield for beginners to look for? Generally, something between 2% and 6% is common and stable. Anything above 8 or 10% requires deeper research. Instead of chasing high yields, beginners should prioritize dividend safety, company financial health, and long-term consistency. A company that pays a smaller but reliable dividend over many years is usually better than one offering a massive dividend that collapses after a few quarters. Another important concept beginners need to know is the payout ratio. This shows how much of the company's profits are being paid out as dividends. A payout ratio of around 30 to 60% is considered healthy. If the ratio is too high, like 90 to 100%, it means the company is giving away almost all its profits, which may not be sustainable. But keep in mind, what counts as healthy depends on the industry. Utility companies, for example, often have higher payout ratios because their earnings are stable and predictable. Next, let's talk briefly about taxes. In the United States, dividends are taxed, but not all dividends are treated the same. Qualified dividends are taxed at a lower rate, while ordinary dividends are taxed like regular income. This depends on how long you've held the stock and what type of company it is. Some investors also choose to hold dividend stocks in retirement accounts like a Roth IRA or traditional IRA to reduce or eliminate taxes. Beginner investors should be aware of taxes, but they shouldn't stress over them, especially in the early stages. Now, what types of dividend stocks can beginners consider? The first group includes blue-chip companies, large, stable, well-known businesses with long histories of paying dividends. Think of companies in consumer staples, pharmaceuticals, banking, energy, and telecom. These companies may not have explosive growth, but they have reliable profits and consistent dividend payments. The second group includes dividend growth companies. These companies not only pay dividends but increase them every year. Over time, the dividend you receive becomes larger and larger, even if you never buy more shares. Dividend growth investing is incredibly powerful for young investors because it combines income today with higher income tomorrow. The third group is high-yield stocks, companies that pay much larger dividends than average. These include real estate investment trusts, business development companies, and some energy companies. They can be great for income, but they also carry more risk. Beginners should start slowly and diversify if they choose these types of stocks. Then we have dividend ETFs, which are perfect for beginners who don't want to pick individual stocks. A dividend ETF holds dozens or even hundreds of dividend-paying companies. When those companies pay dividends, the ETF pays them out to you. This gives you instant diversification and reduces the risk of relying on any single company. Popular dividend ETFs include ones that focus on high dividends, dividend growers, and broad market dividend indexes. For beginners, ETFs offer a simple, stress-free way to start earning dividends right away. Let's now look at how you actually get started with dividend investing. First, you need a brokerage account. Any major platform works. Just choose one with low fees, an easy-to-use app, and automatic dividend reinvestment options. The second step is researching dividend-paying companies or ETFs. Look at their dividend history, payout ratio, earning stability, and long-term performance. Avoid companies with inconsistent earnings or extremely high yields. The third step is deciding how much to invest and how often. Many beginners start small, maybe $20 to $50 per week, and build over time. What matters is consistency, not the size of your first investment. The fourth step is reinvesting dividends. Most brokerages let you turn on automatic reinvestment, which means every dollar of dividends gets used to buy more shares immediately. This is where compounding begins. Even small dividends, when reinvested, can lead to huge growth over the years. The fifth and final step is patience. Dividend investing is not a get-rich-quick strategy. It's slow, steady, and reliable. The longer you stay invested, the more powerful your dividend income becomes. So who is dividend investing best for? It's perfect for beginners who want a simple, low-stress way to build wealth. It's great for people who like predictable income. It's ideal for long-term investors who understand that consistent growth beats short-term hype. And it's especially powerful for anyone willing to reinvest dividends year after year. Before we wrap up, here's the truth that most beginners don't realize. Dividend investing isn't just about the money you receive, it's about the mindset. It teaches discipline. It encourages long-term thinking. It rewards patience. It helps you stay invested even when the market is volatile because you know dividends are still coming in. The most successful dividend investors aren't the ones who chase the highest yield, they're the ones who stay consistent, reinvest, and let time do the heavy lifting. So, if you're just starting your investing journey and want something simple, proven, and beginner-friendly, dividend stocks might be exactly what you've been looking for. They offer income, stability, compounding, and long-term wealth, all without needing to trade actively or take massive risks. That's why so many investors around the world rely on dividends as a key part of their Financial strategy. If you found this explanation helpful, make sure to hit the like button and subscribe to Stock Predictor for more clear, beginner-friendly investing videos. Let me know in the comments which dividend stock or ETF you're planning to research next. Thanks for watching, and I'll see you in the next video.